Welcome to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He is president of Asset Preservation Wealth and Tax here in Arizona. And we are going to talk about what's happening in the markets today. Stewart, how are you today?
Oh, man, the heat is gone. I'm finally enjoying the weather here, having a good time.
It's beautiful. It really is beautiful. But I come to you, Stewart, with everything market related. So I have to ask you a question. I'm coming home every night. I'm turning on the news, and it seems like I'm getting more and more bad news regarding the markets. So what's really happening?
Well, I think at the end of the day, you're being served up bad news, and there's some good news, there's some bad news, but people tend to click on the bad stuff first, right?
That's true.
And so I think sometimes you have to kind of decipher through the mess and figure out what's up. But here's what I'll say is that obviously through the end of November here. The S&P 500 has done incredibly well. The stock market's done well. Bond markets have gotten pummeled here.
Yes.
And so I think, with the interest rates rising, Jerome Powell succeeded in kind of slowing down inflation. We're down under 4%. And so that's, had some good effects. It's also had some damaging effects, which I think were intended. Remember, the purpose of raising interest rates isn't just some offset reason. I mean, the purpose is to slow down the economy, and that hurts. It's painful. One of the things they've done a lot of damage to is obviously the mortgage industry, right?
Yes.
And
Yes.
It's had less effect on housing than we've thought so far.
It's true.
I think because we've had such an influx from California, people still want to come to Arizona.
Sure.
They're coming here in droves still.
Absolutely.
But we're seeing a lot less of real estate transactions, so it's adding some definite issues here.
Sure.
But I think the rising interest rates and their effect on bonds have been really, really crazy because historically people have just moved to the 60-40 portfolio, the balanced portfolio, and that's gotten hurt.
Wow. So the 60-40 has gotten hurt. So I have to ask you a question. If people are nearing retirement and now the 60-40 does not come into play because perhaps they're using bonds to protect them, what can they be doing right now? Yeah,
and the 60-40 portfolio got hurt, but so did target date funds. Target date funds got smashed because typically, these are rules-based, systems, and as you get closer to retirement, these target date funds will move you from, call it 70-30, meaning 70% equity, 30% bonds, to maybe 60-40, then 50-50, 40-60, et cetera. And basically, by being more conservative, they tend to add more bonds. Well, what we've seen here with these rising interest rates is that bonds haven't added the safety that people were depending on over the last couple years. And so, look, if you look, through the end of November at the S&P 500, it's up substantially. I have a graph I want to show you, Cynthia. If you look at this one here, look, the S&P through November, mid-November, is up 18%.
Wow.
But if you take a look at that red line right there, and by the way, the blue is the S&P 500. The red line is ticker symbol IEF. That's the 7 to 10 year Treasury ETF from iShares. So 7 to 10 year bonds. The green is the 20-year Treasury ETF called TLT from iShares, and that's down almost 10%. So a lot of conservative investors, Cynthia, have basically seen themselves hurt because these conservative positions, the bond counterweight or the safety places, have basically pulled down all of the return from the market. So people are now on their second year where they're not seeing any real return, and that's a problem.
Sure, sure. So obviously people are now understanding that there are risks that come involved with the bond fund. So I have to ask you, what can they do moving forward, Stuart? What should we be doing right now?
Well, I mean, look, the great news is that short-term interest rates are really high. So there's been a lot of people that have moved towards, safe money. Money markets are great. We're seeing because Charles Schwab is one of our custodians, we're seeing over 5% money markets through November here. 5.25 was for anything under $1 million. Over that, I think it was 5.4 or so. Don't quote me on that. But very attractive short-term rates, right? The yield is fantastic. But remember, there's some downsides to that too, because as interest rates rise, bond values go down, and that's an issue. And what we've seen here is that people have run to safety. A lot of people anticipated this. We knew that interest rates were going to be an issue, so we shortened the duration on our portfolios. We tended to use shorter term positions. Our money managers all felt mostly the same way about that. Some saw it slightly different. But a lot of people over the last couple of years ran to safety, and they bought products like annuities, especially, they went to a seminar. They heard somebody on the radio that was selling annuities, fixed annuities in particular, and when they went to buy those, they bought them to protect their downside. Well, the problem is when they bought them during the lowest interest rate environment in history, and the underlying positions for that what supports those investments are generally fixed instruments like bonds. And so if you bought an annuity over the last couple years to protect your downside, well, the problem is you're now invested in a long-term investment that isn't doing very well, which is why when interest rates are low, I get it. You want to protect yourself, right? Because when interest rates are low, they're trying to stimulate the market. But that also means the internal yield of those products aren't very good. But here's the good news. Interest rates have skyrocketed, and that's allowed us an opportunity to refinance our way out of that position. And what I say is when interest rates are low, you refinance your house. When interest rates are high, you refinance your retirement. And so if you ended up buying an annuity from a person at a seminar who sold you something and kind of disappeared, well, you know what? It's time to consider refinancing those. Because if you're on your second year of no returns, well, guess what? There are way better versions of that product now. And now there's so much yield in these portfolios compared to what there was a couple years ago that you may be able to get out of that existing product that you have, bonused out of there without any sort of real incursion into your principal and not incur that penalty, or at least have it reduced by a bonus. So if you bought an annuity, you're concerned about that, we'd be glad to give you a complimentary portfolio review, give you a second opinion on whether or not that makes sense to refinance, to get out of those fixed annuities into something that can earn something better. But if you want to do that, you have to take action. Give us a call at 833-602-7526. That's 833-602-PLAN. Or even easier, you can go to assetpreservation.com. That QR code on your screen right now, if you pick up your smartphone, you click on that, that'll take you to the website, claim your absolutely free portfolio review. We'd be glad to give you that second opinion.
Stewart, thank you so much. To our viewers at home, that number to call is on your screen, 833-602-7526. As you can tell from listening to Stewart today, obviously it is very important to understand how much risk you are currently taking. Do not miss the opportunity to call in for this complimentary portfolio review, or like Stewart mentioned, if you have your smartphone handy, go ahead, grab it. Click on that QR code at the bottom corner of your screen. That will take you right to Asset Preservation Wealth and Tax landing page. We're talking about market risk right now on the show, but we're also going to be talking about some tax planning in the future segment, if you will. So stay tuned. We'll be right back momentarily.
We know the market is going to get worse from here. This is the biggest monthly decline in 10 years. People's 401ks took a major hit.
Well, my investments are tanking. My retirement isn't going as planned. I can't believe I let my kid talk me into buying crypto. I mean, what is that anyway?
This was the fourth worst contraction in history.
So how are you two doing?
Your financial future doesn't have to be uncertain. I'm Stewart Willis with Asset Preservation Wealth and Tax. If you have amassed a nest egg, it's time for a financial advisor to help you reach your retirement goals. We are in one of the greatest tax windows in history, so it makes sense to take advantage of this tax discount while you can with your partners in retirement. All of our expert advisors, CPAs, and enrolled agents are fiduciaries that specialize in retirement planning, tax mitigation, estate planning, and more. Plan your retirement right. Call right now for your own complimentary portfolio review and tax analysis.
Welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio, joined today by Stewart Willis. He is president of Asset Preservation Wealth and Tax, and we're talking about market risk right now. So, Stewart, wow, it's very important, I would assume, for people to really get their portfolios X-rayed so they can assess if they are actually keeping up with the current conditions. Would that be true?
Yeah, and I think risk is all relative. You know, people have to be comfortable in what they're in because, look, everyone knows you're supposed to buy low and sell high, but oftentimes people do the opposite because there's a couple emotions that guide you when you invest. There's fear and there's greed, right? And everybody has a different balance within them. And so one of the most dangerous things people can do is by listening to their friends at the water cooler or their country club friends or their golfing buddies when they're out drinking, right? Taking tax advice and financial advice when you're, you know, socially, it's a dangerous thing because sometimes the information you get isn't super accurate, right? But also maybe your buddies can just take more risk than you. Right? And I think that people are taking way more risk than they understood, especially those that thought they were conservative with those bond portfolios or those target date funds that really came back to bite them there.
Sure. And that can be quite detrimental, Stewart. If you're close to retirement, you don't have time to wait if you're taking too much risk, correct?
Yeah, I mean, I think it's really important to understand that, look, when you're closer to retirement, you just can't tolerate the kind of risk that you could when you're working. So it's important to get it assessed, to know where you're at. We do those in those reviews that we offered there at the commercial. It's important to take advantage, to know what kind of risk you're taking. Absolutely.
Sure. And Stewart, something else you're very passionate about. You love talking about taxes. You are very good about tax planning. So let's talk a little bit about that. What should people be doing right now to take advantage of the current tax rates that we have?
Well, look, it's super important to understand these end of year tax plans are everything. I am working 7 days a week right now because it is so important. And look, it's funny because, look, I mentor advisors all over the country. And when I look on my Instagram and my Facebook page, and by the way, I encourage you to follow me on Instagram and Facebook and, you know, get to know me a little bit better if you are interested in that. But look, I follow other people online, a lot of these advisors that I help out in, you know, we're trying to guide them into how to create a real planning system, how to do the kind of advanced planning we do here, because it's just very unique, you know, to our firm.
Sure.
And what I see all the time is that these guys are out golfing 3 days a week, or they're, you know, traveling constantly, vacationing. And look, in December, a lot of advisors just turn off their work, right? They close it down for the holidays, and I would love that. The problem is this is the best time of the year to do tax season right now. Okay, including this year, we have 3 years left in the most efficient tax window in history. And it's very important to understand what I'm talking about, okay? I've shown this slide before. It's our tax bracket slide I'm going to pull up now. And what this will show you is an overlay of the current tax brackets in red versus what they used to be back in 2017. The red is after the Tax Cut and Jobs Act. Now, the dollar amounts, which are really small at the bottom, were what the original thresholds were. They've since been adjusted for inflation, so they're much higher. And a lot of people believe that the Tax Cut and Jobs Act only benefited people at the higher income brackets. But most of our clients are between the 12% and 24% bracket. And here's the thing to think about. If Congress doesn't extend the tax cuts, which I think is very unlikely, I think it's very unlikely that they get extended, that we're going to revert back to those blue tax rates at the end of 2025. So Cynthia, let me just tell you this. It's important to have a plan that takes advantage of this window that we're in right now. And so what we do is we have different strategies, different tools that we use. We take advantage of capital gains and capital losses called tax loss harvesting.
Okay.
Because take a look at this. Even if we have a portfolio that's made money this year, there's probably some positions that have gone backwards, right? So if we, remember when I showed you that bond in S&P 500 slide, you know, it's worth maybe considering harvesting those positions to take advantage of any capital gains you have to wipe out those taxable positions. It's really important to do that. So tax loss harvesting, important, but also looking at the concept of a Roth conversion. I've talked about it numerous times. It is super important to a plan.
Well, I want to talk to you in depth about the Roth because obviously you're very passionate about that. Let's talk about what is it and how does it benefit someone for tax planning?
Well, so just remember, with a regular IRA or a thrift savings plan or a 401k, you were always told during your working years that if you put your money away tax deferred, that you could take it out in retirement when your income is much lower. And your income probably will be lower. But the question is, will you be at a lower tax rate or not? Maybe, maybe not. It all depends. It's worth the analysis, okay? Well, with a Roth IRA, you don't get a tax deduction, or a Roth 401k or a Roth thrift savings plan. You don't get a tax deduction for putting away. In fact, you have to pay taxes on the money you still put away into these relative plans, these Roth plans. But here's the benefit. If it's been in there for 5 years or longer, all of the principal, all of the growth, all the withdrawals you take are completely tax-free.
Wow.
And what other people don't think about is they put away this money tax deferred into these vehicles, once again, thinking their income's going to be lower. But what they don't think about is the fact that a couple things happen in your 70s. Number one, it's the latest you can take your required minimum distributions, right?
Absolutely.
At 73 years old, you have to now take these money out because Uncle Sam has said, hey, you've put away your money away, tax deferred long enough. It's time to show me a piece. I want to get paid, right? Uncle Sam wants a piece of it.
Yes.
Something else happens at 70 years old. It's the latest you can take Social Security. And look, we were originally told that Social Security would never be a revenue source for taxation. Franklin Roosevelt said that.
It's true.
But in 1983, it became taxable for the first time. In 1993, it became more taxable. And what makes it taxable is all of your other income. So it's called provisional income. That includes your IRAs and 401k income. So people come into our office, they've put away $500,000, $1 million, $2 million into their IRAs. They've done their jobs. They did what they were told. But what they never understood was that by deferring that money, kicking the can down the road to a period where we believe taxes will be higher, they're also going to have to start taking it out now, not only when taxes are higher, but also when they're going to start having to pay taxes on Social Security. So you have the convergence of these two taxable income streams that work against each other.
Yes.
So it's really important to understand the impact of your IRAs and 401ks on Social Security, which is why a Roth conversion is when you take your existing IRAs and 401ks now, you convert it from a traditional IRA or 401k or thrift savings plan over to a Roth.
Okay.
The problem is you have to pay the taxes this year, right?
Okay.
You have to pay the taxes as you do it.
Okay.
The benefit is that it's all tax-free when you take it out. It's also invisible to Social Security. So the important thing is to take advantage of the next 3 years to your advantage, right? Taxes are going up. And listen, all the time people say, well, how do we know they're not going to extend them? Cynthia, look. When they dropped taxes in 2017, they did it during the greatest economy the world's ever seen. We're not there anymore.
No,
we're in
we're
a
not.
different place. We've spent trillions of dollars on COVID.
Absolutely.
Right? And here's the other thing to think about. I was watching one of the Republican debates, or at least snippets from it, and what really scares me is I started hearing something from Chris Christie here. And Chris Christie, one of the candidates, less than 1% of the support of the audience. I don't know why he's still in the race, or why he was in the race at the time of this debate. But, what he's saying is that, hey, Warren Buffett doesn't need Social Security as bad as, the common folk. Well, we know that's true, right? It makes sense.
Right.
But to me, that's also a dog whistle saying, hey, we're coming for Social Security. Because,
It's true.
What I heard a couple months ago and really, really, really scared me, I get scared a lot apparently, is when Lindsey Graham and Bernie Sanders agree on something. And what they agreed on was that higher income folks don't need Social Security as much. Sounds very much like what Chris Christie just reiterated.
It's true.
It's what they said in 1983 when they started making Social Security taxable, because what they said is higher income folks don't need Social Security as much. So they started taxing Social Security for the high income folks. But here's the thing. They've never adjusted those thresholds for inflation. So more and more people have to pay tax. And really, who's the wealthy, right?
That's true. Absolutely.
Is it the person that makes $30,000 a year, $44,000, $100,000, $200,000, $300,000? I don't know. But once they start imposing those kind of penalties and tax, or if they take away your benefits, that's the bigger problem.
Sure, it absolutely is.
And what the Roth does is the Roth right now is completely invisible to any of those Social Security taxes. it's important to plan.
Wow. Well, Stuart, we're going to take a very short commercial break, but I have to ask you quickly, if the Roth is so amazing, why aren't other advisors pushing their clients in that direction before we take a break?
Yeah, you know why? It's because oftentimes most financial advisors are prohibited by their firm from giving tax advice. But also, you know, what the advisor will say is, you know, listen, I have a friend, she's a fantastic financial advisor over at Charles Schwab, Kathy Strong. She's fantastic over at the Scottsdale branch there, love her to death. And she's like, Stuart, you're killing me with all this Roth conversion talk that you talk about, right? And you know, so these people get bombarded by our TV show and are talking about Roth, and what happens is that a lot of times these financial advisors can't give tax advice internally, right?
Yes.
And you know, there's other advisors that you know, say, hey, go talk to your tax person. Your tax person says, go talk to your financial advisor, and guess what happens? Nothing. Nothing ever gets done because you can never get them together, right? And so, anyways, I think it's really important to make sure that your financial advisor and your tax planner are all together. They communicate. They can all do it together. And if tax planning isn't part of your financial plan, we are offering that complimentary portfolio review. If you give us a call at 833-602-7526, that's 833-602-PLAN, or even easier, click on that QR code. It'll take you to assetpreservation.com. We will do that absolutely free tax analysis and portfolio review. But you have to take action. Tick tock, tick tock. Don't wait till next year because we only have 3 years left. Don't waste them.
Stuart, thank you so much. To our viewers at home, that number is 833-602-7526. We know you have a lot of questions for Stuart about tax planning, about Roth conversions. He is offering you this complimentary review. Don't miss the opportunity to take advantage. We do have to take a very short commercial break here on the Asset Preservation Hour, but stay tuned. We'll be right back momentarily, talking more in depth about the difference between tax preparation and tax planning. Stay tuned.
People are really concerned about outliving their money. Inflation, taxes, volatility in the markets, legacy. That's what people are really concerned about. Listen, I love what I do. When a client of mine can know with total confidence that they're going to be okay. At Asset Preservation, that's exactly what we do. Not only do we look at your investments, we look at your taxes and estate planning as well. We don't leave any stone unturned. That is what a real holistic shop does. Provide a very clear roadmap so that you know it's okay to enjoy retirement. Success is being able to sleep at night. And at the end of the day, what we provide at Asset Preservation is not only the market expertise by institutional money managers that are some of the biggest and best in the world, but we also provide complete advice. You need to make sure you have a plan. What you can expect from us is to let you know the truth about your portfolio.
Welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He is president of Asset Preservation Wealth and Tax, and we're going to talk about the difference between tax preparation and tax planning. So, Stewart, you're so passionate about tax planning. To our viewers at home, maybe they're confused between the difference of tax prep and tax planning. Let's talk about it.
Yeah, and look, I am passionate about tax, but, you know, I tell people all the time, I really feel like I was faking it for the first decade of my career for a couple reasons. One of them being that I didn't understand tax the way I do now. And look, it took a lot of years of running a tax office, and it is a nightmare. It is a lot of work having a tax office built in. And, you know, listen, the beauty of our message is that other people have started to spread it, to copy it. Other financial advisors realize that, hey, this conversation is working, so they have the same conversation. But they don't have a tax office built into their office, and I think that that's something missing. Look, I don't like having to pay CPAs and enrolled agents year-round on our staff. Right? I don't like paying it out.
Right.
But the beauty is it adds so much important information. They do our cash flow analysis, our planning, etc. But tax preparation is what happens between, you know, February 1st and April 15th generally. That's your tax preparation. And look, these enrolled agents, CPAs that work for us, they work their tails off. They're working 10, 15-hour days. So are your tax people as well. It's the worst time to get tax advice. They just want to get through the tax season to prepare your taxes, right? It's the worst time because they're exhausted. Don't plan it then. Use them when they're fresh, and that's right now. So at the end of the year is our tax planning season. And what our tax planning season is when we look back, we look at what kind of capital gains you have. Maybe it makes sense to do some tax loss harvesting, to harvest your gains against your losses, to neutralize each other, to create a more efficient tax plan. But it's also time to look at whether that Roth conversion we talked about earlier makes sense for you. So many people have said, hey, Stewart, I know Roth is better, it sounds better. I'm like, well, why didn't you do something about it, right? People just don't take action. You know, our busiest show, when we have a show, our biggest response is right after New Year's Eve. Right?
Really?
So right after, because people are making New Year's resolutions. It's the same reason the gym is packed in January and February. And guess what? It's empty now. Why? Because people have forgotten about it, right? Look, my buns are a little tighter right now than they were at the beginning of the year, right? It's because people, out of sight, out of mind. But tax planning is important. I look back, I see these financial advisors that take December off. You know, I'm on my Instagram, I see them that they don't do anything in December. They're traveling, they're vacationing, and I wish I could do that. But it's the most important time of the year because we can look back and say, hey, you know what? Maybe you got a bonus or earn some extra commissions at work or whatever, and we can take advantage of where we are now. And if you're not doing it, you are just wasting time. I promise you, whether it's with us or somebody like us, make sure you do some advanced tax planning at the end of the year. It is absolutely critical because remember those tax brackets I showed you earlier? I'm going to pull up that tax bracket slide one more time just to re-emphasize this. Tax planning is about using your brackets to your advantage, right? So going from 10% to 12% is a small jump. Going from 12 to 22 is a huge jump. 22 to 24 is a small jump. 24 to 32 is a huge jump, and then they're kind of incremental from there. But you have to realize, look at that 22 to 24% bracket, right? Most of you are somewhere in that range there. And look at where it's going to be 3 years from now. It's going to be back to blue if Congress doesn't act. So, audience, I tell you this, take advantage of where we are right now. Have a tax plan. Don't wait till next year, because just waiting the next few weeks, by just waiting the next few weeks, you're wasting another year in your tax plan. So we encourage you to give us a call at 833-602-7526. We'll squeeze you in. It's going to be tough, but do that. Go to assetpreservation.com, click on that QR code, take action before it's too late. We'd be glad to help.
Stewart, thank you so much. To our viewers at home, thank you for spending time with us today on the Asset Preservation Hour. We know you have a lot of questions about how much risk you're taking in your portfolio and about tax planning. Don't miss the opportunity to call in for that complimentary portfolio review, 833-602-7526, or go ahead, click on that QR code that will take you right to Asset Preservation Wealth and Tax landing page. Be safe, be happy, be blessed. We'll see you back 1 week from today. Take care now.